Um, Now, I tried to put some slides together for the introduction to high tech, but of course that's a very tall order to introduce you to all the high technology, how to do a high tech startup. So my focus has been twofold. One is that please feel free to ask, make it very interactive, the discussions, because there's a lot more information in my head than it is actually on the slides. The second is that I try to focus from a research perspective, to bring across some concepts which as researchers, at least I was not used to when I was in Bell Labs for a long time in Bell Lab research. And so I was looking at the perspective of a researcher and says, okay, what is this business all about, and what, why are the things the way they are in the high technology world, and what are the challenges as a researcher you face, and I had to overcome when I did my research. Now, my own background is that I spent God knows how many years in Bell Lab research, left in 2000 to do a first startup called ISP Soft, which was funded by Lucent. We sold that 2001. Then I joined a public company called DSET, ran that public company, took it private. So it was a very interesting experience in the sense that I don't know of any other person who, after 2 years of leaving a research lab, was running a public company in the height of meltdown, high-tech meltdown. It was a very unusual experience and a fun experience, which I don't want to repeat, by the way. So I got so tired that actually that's why I actually became the executive director of YCAT, Wireless Center at Poly in Columbia, to try to create that wireless center. And then, of course, I did startups. I went back. So one of the things with the high-tech startups is that they're very tough. They take a toll on your life, but they're fun. They're addictive. So once you do them, it's like I keep on going back to them. Okay. So there are really three portions I wanted to discuss. The last one actually is very key. So I'll try to make sure we have enough time for that. Is a 15-minute talk or? 1 hour. Okay. So but I'd like to talk a little bit about the research, entrepreneurship, and the high-tech startup concepts first. So I knew that when I was in Bell Labs, we always had this complaint is that you have a bright idea. Why is it so difficult to commercialize a bright idea, right? So it's like we can talk a lot about that, but one of the key things actually which I learned which took me so in the research, right, we had this view that if you make a big enough breakthrough in research, it should be a self-obvious business. So one of the realizations I learned over the years was that actually usually bigger the breakthrough, the harder the business it is. So which is actually totally opposite in most of the cases to what you would expect. And the reason for that is actually very simple. If you are making a breakthrough in the business, you need to change a whole lot of things around you, economic, for it to be absorbed into this commercial world, if you will. And that increases the difficulty substantially of making a successful business out of it. Right? But clearly the ideas are the same. There's no existing model. It conflicts with the existing model, which was always the case with AT&T. So it was not that Bell Labs was stupid or engineers were stupid. Everyone knew about IP. But the AT&T was business units were not stupid either. If you had $100 billion worth of revenues, why would you go out and offer the same voice services on IP if the revenues were going to be 10 billion on that, right? So they had this is too small an initial potential, which is a big problem with large companies. For example, in Lucent, when I was there, one of the criteria for a new business to be successful was that it should have $100 billion revenues in the first 2 or 3 years. If you could not reach $100 billion, they weren't interested. And the reason was the company's overheads and expenses were so high, and they're looking at competing opportunities. So now you can argue that was a bad idea, but it was a criteria for that. And that's why Lucent lost a lot of opportunities down the road for this initial potential. Decision-making processes. Typically what happens is people who don't do anything never get fired for not doing anything. And people who take the risk, and if it fails, they lose the job. So there's an inherent risk. Of course, investors simply don't get it. Now that is actually, which I'll talk about, is really a factor of time, geography, sentiments, waves, fads. People will tell you it's a very logical process. Investors are far from being logical. Right? They have a logic path, but it's weird, which is, and I'll explain that what it means. So I'll just skip this one because you're probably familiar with that. That if suppose the WinLab comes with something, you spin it out. You have a separate sales and marketing team. There's some issues with there which are probably not the right. I'd rather skip this actually. The only part here from WinLab I would like you to focus on is that there's a huge gap between when you go to investment. There's a huge gap between the research idea prototype and even the commercial prototyping. So and that gap needs to be filled. So in fact, I know Ray and I had several discussions of creating a center with State of New Jersey which would actually fill that gap for WinLab projects. Of course, given the State of New Jersey funding and the budget shortage in state, that has gone nowhere. But that's what I think what we need here. So let me go back to the straight to the interesting part of the talk. One is that what my personal views were from research versus business. So one of the things I noticed was that when I was doing a research problem, it was usually very well defined. And the problem is actually quite open. So we used to be being very smart, like somebody formulates a problem. If it's a mathematical problem, you improve it. There's a competing paper, you can improve 5% and you're very happy with yourself. You improved on the mathematical result, the same assumptions. And then as Bob Lucky told me once, you can he gave me an algorithm to define infinite research problems. He says, keep on optimizing, scale things down, you get a new research problem, scale things up, you get a new research problem. So he says, almost take any research problem and you'll find that to be true. You scale it down, you get another problem, scale it up, you get another problem. So you can generate new research projects forever. But in business, actually, the problems are quite open-ended, which makes it very tough for as a researcher to grasp. The success criteria. Business is very broad. You can be the smartest person in the world. You might have done all the right things. If you don't make money for your investors, you failed at it, basically. That's the bottom line. Might prepare you better for the next startup, and that's where the Silicon Valley startups do well. They actually appreciate failure because your past failures, because they think it makes you a better businessman, entrepreneur for the next one. On the East Coast, the culture is still a bit more conservative. If you have a failure in your history, it's a black mark against you. So that's the way it is. Information in research, we usually have almost all the information we need to solve the problem. In business, one of the hardest things is the information. It's incomplete, random, and very hard to come by. And people don't share key business information with you. It's like that's the very hard part. You have to talk. They have to like you. One of the reasons why people say that in the businesses, it was so hard for women to make it to the top with men. Part of the reason was actually this after-hours socializing, because the information is shared, and that always forms a barrier initially. Now that barrier is breaking down, so which might happen the reverse way, that women might have a network of their own and the men have difficulty breaking it down. Execution control. From research, you pretty much have a good research control on your own pace. In business, the external factors dominate. What your competition is doing, what the market is behaving. The fact that the Wall Street went down, the Dow Jones went down, has an impact on your business. And you can, or if there's a war in Iraq, or so these factors, these are macro. There's a lot of smaller events which are risk. Now I want to talk a little bit of the risk. Is that this is another misconception I had from research, was that if I'm very smart and if I work hard, I deserve to make money in business. Because a lot of people from who worked in large companies, they want to do a startup and they start asking the investors for 15% of the company, 20% of the company, which is very high, given that the whole pool for the employees might be 15-20%, right? And the reason for that, many of the people use the same argument that I'm very good technically and I work very hard, so I should get it. But the problem is that business, the rewards are proportional to the financial risk you take. It's simple as that. So somebody who may not even have gone to school, if they were the first person from the company, they have a full right to get 5 times more than the Nobel laureate who joins 2 years later the company. Right? So that concept is very important to grasp and the financial. That's why, in fact, if you look at it, the people who took the highest risk, Bill Gates, dropped out of college, or Steve Jobs, all these people, they make it really the big. And actually what they've done studies, they found the professionals like myself with PhDs, we don't do as well for several reasons. And the reason is that risk-taking ability has lowered over the years. Second is that you're already making enough money. So you take risk on 2 things, right? One is that you want to take the risk. Second is that the downside, you're not losing much. Now, when you're a professional with a well-paying job, and if you start calculating the expectation, they found out that the expectation is actually for doing a startup is lower on the average than if you would stayed in a large company job. I don't want to dissuade you, but you should know that. So now in research you do take risk though. So like in Bell Lab research you did take a lot of intellectual risk, which is essentially I should say intellectual, not reputation, which is actually something very important to understand, that the reason places like many Bell Lab research were good at some point in time because people were prepared to take intellectual risks. That has changed. So I still remember my first interview in Bell Lab research was Bob Lucky told me that if your ideas are applicable less than 10 years from now, don't bother coming here. Right? And of course that had transformed to saying that by the time I left, I was a department head then, my manager was telling me that the outside companies have done this, why don't you copy what they've done in a sense, or startups. So the things have really changed in Bell Labs. Creativity, of course, intellectual but very high and multidisciplinary in business. So what is business fundamentally? Because I'm assuming, I know some people know what a business high-tech startup is, but I'll assume 80% of people don't. It's very simple. Is that it's supposed to be very simple, right? You have an idea for technology, so assume that you know what competition is doing, ecosystem is doing, you know what the customer needs are. You say, okay, I build a product. So remember there's a difference between technology and products, so I'll explain more to that. And then he says, oh, I'll just sell it. But then when you start doing that, actually it's not easy at all. You have to find out who the buyer is, right? Where is he located? And he means he or she, or corporation for that matter. How do I reach him? These are all non-trivial questions. Does he have money? What price is he willing to pay? And how do I service him? So if you have a customer, for example, you might get a customer like one of my startups, you have a customer in actually India for that matter. Now how do you actually take 5-10 people support, send them over there? Because in the beginning they don't want to pay you much unless you prove it works for startups, right? So so business can be very hard and fun, but it's fun. Yeah. So what happens is that I'll talk more about it. The product has to the product and the business has to fit in with a lot of existing companies which are offering services and products around that. So to give you an example, suppose you came with a billing system for a hospital or a model. Now the billing system in a hospital has to work with, or let's say telecom carriers, easier example to this thing. So you say the billing, I have a better billing system for CDMA based technology or whatever Verizon new offering is, EVDO, whatever, it's faster, more real time. But then the problem is that Verizon already has, wireless already has so many other software solutions which work. So it needs to work with all those things. It needs to work with previous technologies. So the whole thing is equals. Then it's also possible Verizon Wireless already has contracts with 2 other companies who will provide them the software solution. So even if they want to buy yours, they can't buy it from you. So to find those, convince those people. So the whole thing actually, instead of explaining too much at this stage, I just said ecosystem. So it makes it actually, but important point here is that first, product is very different from technology. That was the main lesson here. Second was that just that buyer thing has poses a lot of fundamental questions. Okay, so I'm just giving my view of what happened when I first saw that from a research perspective. And marketing is that my first view of marketing was that what do we need these people for? All these people do is burn money, right? It's like all these nice pretty brochures and pictures and stuff like that. Sales is like, these people are, a lot of people say sales people are sleaze buckets. I kept on hearing in the research, right? Now, of course, I really appreciate the salespeople in the company. Product development, it's very intellectually boring. Who wants to go with all these hundreds of thousands of features you need to, put in, which takes 90% of the effort actually in the product. Investors, they are a pain to deal with. Right? Legal, wish we didn't need them. Financial, so financial also, never appreciate the financial guys because they are bean counters. We are not going to have profits in the first few years, so why we even bother with them, right? So let me just go why we need all of these people. First, the fundamental thing of a market, right? So a lot of people don't understand what the market is. Actually, it's very simple. It's a set of customers you define with some common attributes. That's all they are, right? So it could be, for example, if I was a salesman, I could say that audience in this room is my market. And what it happens is that technology, you could come with the same technology, technical concept, but the product will be very different based on the market you pick. So, and that's something which is actually, and that's one of the reasons why most of the CEOs of companies are marketing people, because they're not salespeople. Salespeople are very short horizon because they need to make a sale this quarter or stuff like that. Marketing people almost have to deal with strategy because you define the market that defines almost product, and I'll talk more about the marketing concepts. So the market can be based on a number of things: geography, high income, function, and it's not necessary that you have a new concept or a new technology. Like example of geography will tell you, right? Just because they are local, each gas station is virtually the same as any other gas station. Just because they are local, they have a business. Right. So one of the things I want to mention is that it doesn't have to be the next breakthrough technology stuff. It must be addressable. You should be able to. It should be real and sell. You should be able to sell to it. So just to give you an example, suppose you have a market in a country in which U.S. government has banned exports to that. So it's not a real market, addressable market, right? So it has to be real, and you should be able to sell to it. So this is very important things about the market, some fundamental things, notions about the market. Very obvious, but important to know. So the way I looked at it was very simple. I said, oh yeah, it's a huge set, and I just need to define a subset with some properties. And actually that helps me understand a little bit more. So the key things, why I say the marketing is key actually is that most people think marketing is PR. But actually marketing has these 4 functions which are very important, which are key to the success of any high-tech startup you do. One is that what is the market, of course, to define that. That is implied once you do this thing. Once you define the market, the strategy to reach the market is a key. Once you understand that, the product management, the defining the product and the pricing is very key. So remember the product. So for example, you came with, to take an example, suppose you came with a method of compressing, or let me make a simple example of designing a cheaper way of designing a ASIC chip, or certain kind of ASIC chip for wireless applications. You can sell that as a core technology product, and say that's my customers are going to be other technology companies. you can use the same idea to say that, okay, I know that somebody wants this for home use, an audio consumer chip, which can a wireless one for communication. So I'll use my know-how to build that chip better and faster. There's so many ways to take the same technology breakthrough and make a product. It's a very creative part of the business. And I think a lot of the startups fail, high-tech startups fail, right at that stage, because they take the technology and go for the most obvious mapping which occurs to them in terms of the market. So yesterday I was actually in a meeting with investors who brought me in to listen to ex-president of AT&T for a business plan yesterday. It was very interesting. They have this technology in which they can take multiple they made a small box which you can communicate simultaneously on multiple wireless technologies, right? So the whole business plan proposal was that you use that and we'll send it on singular AT&T, all these carriers simultaneously, and that way we'll have a much better reception, right? Now if you start thinking about it, like from the business point of view, it's very hard to make that work. You have to license, first of all you have to have data subscription on all the 3 carriers, which makes your cost 3 times as high. The box is like this big for that. The cost of the device was so big. So, my questions were again asking, even for the seasoned people with telecom and other things, my questions are, what are the markets you explored? And they're not. It was actually almost, they took the basic technology. I think that technology could have a lot of potential. You start thinking about it, why don't you use it for Wi-Fi inside the companies? Better coverage, more reliable coverage and stuff. So one of the biggest problems is that most people take a technology idea and go for the obvious mapping and the product and stuff. So now most people are familiar with these collaterals and publicity, but these are really meant to support these 2 functions. So unless you have defined the market and the strategy to reach the market and the product management, these things are meaningless. You're burning dollars, money. So another thing which I personally had a hard time understanding is that why is it so hard to reach the market? So I came up with this hypothetical example. Suppose you came up with some medical device which helped remove limp on people's left leg. So the question is that how do you find those people? All the people in the world who have limp on their left leg, right? So you can start brainstorming and say, okay, maybe let me go to a doctor. Let me try to reach these people through doctors. But then the question comes is that who are those doctors that people go to for the lift? Do they actually go to a doctor at all to report they have a limp on their left leg? Because if people don't have a solution in the market for that, they will not even bother telling the doctor, right? So doctors may not even know that. So what happens is that you can actually construct very simple cases from a research perspective. They're saying that how marketing has become such a challenging problem based on the product you have. So you can use it like saying it's a huge finance state machine. How do you reach the states? But the cost that is associated with the cost of reaching the market too. That even if you came with some very nice product, try to get shelf space from Walmart for a product is one of the hardest things in the world to do. Even if you want just 2 foot of shelf space for your product, you have to go through the huge processes through selling to Walmart. You have to give them you go with price point of $100. By the time you are out, they'll say they'll give you $10, and then you have to go back and revisit your entire business plan, how to get it done cheaper, because you never thought of that stuff. So the blanket advertising, which is works for consumers, is of course when it's hard to reach potential customers in the market. That's what the default is, blanket advertising. But that's why all the TV ads are. You don't know how to reach them, so you just put ads, give them contact information and support and stuff like that. But that's very expensive. But if the cost is very high, then you really don't have a business unless you included that into pricing. So one of the initial successes for internet advertising was actually for stock trades. The reason was that for getting each stock trading customer, these companies were on Wall Street was spending $300 per acquisition target customer. So with the internet, high-tech startups promised them $1 per customer, right? And then you had all this clicks problem, false clicks and counting stuff. But the thing was that, so they all thought that they were making a fool out of the Wall Street trading firms. But Wall Street trading firms were smarter than they thought. They were discounting that by a factor of 30. They were not really telling them that their real cost was $300. So if it's $2 and it becomes $30, they don't care. So they know all the double counting and the false clicks and the same guy in advertisement. So this is again, some of those things where the advertising becomes important. Because of all the challenges in reaching the market, the direct and indirect becomes a very big issue. That do you want to sell directly, you buying your own sales force in a high-tech startup, or do you want to do indirect? Almost everyone will tell you that indirect is the way to go for high-tech startups. You cannot really compete with whatever companies you have with thousands of salesmen, hundreds of salesmen, coverage nationwide, talking to their customers. And anyway, many of these companies, customers will not buy from you just because you are small anyway. So you will have to go through many of these indirect things. Now typically what happens is, what I found personally the best way to do is that get 1 or 2 pilots. Now you do, okay, let's assume you agreed that you have to go indirectly. But then when you go to these people, say, okay, sell my product, why should they buy it from you? Right? So they say they'll ask you a whole bunch of things, but one of the things they'll ask you is that prove that it works. So in order to prove that it works, you have to find first few direct customers yourself, always. So you typically idea is that you do first 2 direct customers, but you do it from the point of view of convincing indirect channels. They should sell it. The product management, which is always something which fascinated me because I'll keep on learning more. It's actually a very tough problem, coming up with the right product. And the way to best understand is that when you define your technology, it's a really clean square box, nice package. And the customer's actually technology suite looks like an n-dimensional geometric space, right, somehow. So the first time when you go and try to sell it to them, you come back very chastened and sad. Actually, it's a disappointment because you suddenly realize that it's nowhere close to it fits in. So then you define your own product, which looks something like this. But then you still have that shape to worry about. This is where the system integrators become so important in all this you hear about, because they're essentially taking your product and putting in the wrappers around it to fit that n-dimensional space. Now another thing which becomes problem is that what happens if all the customers have different kind of ecosystem and shapes, right? Then ultimately you might have to decide that you're not a product company, you're a service company. Right? The difference between a product and a service company is typically that service is a customized solution to each customer, and product is typically same shrink wrap box you are selling to multiple customers. For typical products, you usually always have 20% of the service component to conform to the product. But if that percentage becomes more than 50-60%, you're better off declaring yourself to be a service company and operating that way, because you can't sell the same copy to 1,000 customers. So because I never understood for a long time what system integrators did when I was in research. So the pricing. There are lots of pricing issues in the product, whether it's value-based or competition-based. Value-based means that if I sell something to a customer saves $1,000, maybe I can price it to $500. Competition-based is that my competitor is charging $500, so I have to beat his price to $400. Market share versus profitability. When the money was cheap in the bubble time, the VCs were giving you enough money to just create market share, which is what the Google actually investors did and the YouTube investors were doing. They're burning money left and right, but then you have to have the right investors for that, which you won't find in New York, New Jersey, by the way, I should tell you. But they'll just take a bet and say, okay, burn money, make market share, and then we'll figure out how to make money of it. Flat versus usage based. There are lots of other ways we can go on and on. Another thing which I wanted to quickly mention was on the sales side. So sales is actually very hard. The reason why it's hard is that sales really comes down to a level of trust between the customer and the company, high-tech company you form. And the trust is of several kinds. Trust is that the technology or the product works. Trust is on the fact that do you trust the people to commit to them to deliver, which is a huge issue for companies. And so one of the so as a startup you find huge number of resistances. Even if suppose you have a very nifty technology, like let's take the example of Flareon, which you must have heard Qualcomm bought, right? So Flareon was actually a spin-off from Bell Labs, and I had a little bit of assistance when it got spun off, because I was the first spin-off from Bell Labs and they followed me, so I became almost the advisor in the beginning. Flareon had an extremely hard time getting any sales out. They had one trial, which of course, and the carrier, and that carrier also withdrew, and I think they burnt up how much, 75, 100. They told me last time they told me they had burnt $75 million. After that, I stopped asking how much money they had burnt. Right. So, but the thing is that the ROI is a very key concept in selling, which is called return on investment. Right. So essentially, it's very simple logically. You say that if you buy this product, how much you're paying for it, how much you're paying for installation, or how much you're paying for people who will support it inside that company, the customer, total cost of ownership, you buy it, and how much is going to make you in money or save you in money. That's ROI, and what period you will get it. Now that changes with time. In the bubble time, if your ROI was infinity, was okay, the period which you get the returns on investment. Right now it is as short as 6 months. So customers will not listen to you, enterprise customers, that unless they can recover the money within 6 months. So barriers have become higher, significantly higher in making a sale. Now ROI is usually you figure out something, but only customers knows, right? Because you need a lot of detailed information on the customer. So typically what happens is that you come up with a generic base, you talk to first two customers, and I'm talking to customers rather than users, because that's a very important difference here to keep in mind. Users don't pay for it stuff, customers pay for it, so keep them distinction in mind. A lot of times as a researcher, we used to talk users and customers are the same. So ROI, return on investment, is custom for each customer. You can have a blueprint, but it will be different. So then they don't know whether the claims of the startup be verified. Do they have the time for that? So you say my product does this and this, but somebody has to test it. And so question for them is that why should they test it? Why should they devote the resources and the lab and the money to test something from a startup which may not work? And even if, and the difficulty of testing, we can test some features, but you really don't know what is under the hood. So a lot of the customers have a huge problem in the sense that they don't know what they're buying, and it's very difficult to convince them. And that's why the reputation of the people doing the company becomes important here. We'll come back to the team factor here. Is there a budget? There have been notorious examples of customers who needed your stuff, who would save the money, but they don't have the budget to buy it. Simple as that. There's no money allocated in their whole budget processes to buy new technology or technology of this kind. So hospitals have been prime example. Hospitals have infinite budget historically to buy the next MRI machine, right? Next X-ray machine. They never had the budget for networking or computer science related stuff. So that's why they're far behind this thing. So when there's a budget, which actually I sat in a couple of the meetings because one of my startups sells to hospitals now. It's very interesting how it works is that so people make business cases based on ROI and stuff like that, right? And it's a no-brainer that the IT product, information technology related product, is what they should buy. But a doctor comes and says that if you buy this next MRI machine, it could save lives of a couple of patients a year, which is unverified, by the way. They'll actually buy that MRI machine, then go on that, even though it's very hard to justify or explain or whatever. So this budget thing is actually becomes a very key process in the sales. Then the next important concept is the sales cycle. I think as researchers, we totally underestimate how much it takes time to sell. For carriers, it's typically 3 to 5 years sales cycle, like AT&T and big carriers like that. For enterprises, which is companies, it usually is from 1 to 2 years. But you cannot really do it less than 1 year, most of these sales. Yeah.
From the conception product to the selling?
Yeah. For the time you start introducing the product, for the time they actually buy it. So this is actually a very simple notion, but is almost very key to planning your business and the financial requirements and the investment. Because if you don't understand the based on the market you define your customers, what the sales cycle is, you're dead. And a lot of people actually got dead because of that reason. So each industry has its own sales cycle notion, and that's why you need to understand your market and your customers, because they'll tell you actually after a few meetings to right people, we will never buy it in less than a year and a half from you. We have not bought it. So the bottom line is that for new products, no matter how good they are, because of this trust factor, whether the technology actually works, the software works, will the company be around in 5 years? Who will support the company if the company goes down under, if a startup? So they need to do a lot of work, and somebody needs to take a risk before they buy. That's why the indirect channel becomes important. So enough about marketing and this thing. I just want to quickly, most presentations on high-tech startup talk about the legal part. So I don't think it's that important yet for high-tech startups. But there's some basic notions which I just wanted to tell you about. The first is that you need typically the types of corporations: LLC, S Corp, C Corp. Historically, the difference between S and C is the S you can have fewer number of shareholders, and you can take the losses and put it as part of your personal tax return. The C Corp, you can have as many investors as you want, though of course you have to be careful that if you exceed a certain number of investors, like I don't know what the exact number is, I forgot, 100 or 200, it automatically becomes public company filing. So a lot of people don't understand and know that being a public company is not a matter of filing paperwork. It actually means that how many shareholders you intend to have in your company. So it's a very interesting legal thing on this thing. So typically what you have in LLC is a partnership, which has become very popular last 5 years. And the reason for that is that some angel investors like it because the losses, each of the separate investors can take the losses on their tax returns every year. So they like that in the beginning. And LLC can be morphed into a C or a S Corp anytime you choose. So LLCs have become popular for that reason. Now, one of the things all of you must understand is the difference between a common and preferred shares. So this high-tech all the corporations have preferred and common. Common is meant for employees, including the CEO and other stuff, and preferred is meant for people who put in money. Right? Now, usually the valuations between preferred and common is 10:1. They allow that. IRS allows that. Now IRS is trying to push for 5:1. So if you was okay, let me explain what that means. Suppose so when you look for investment for a startup, all that means is you're selling them shares at a certain price. So you said, okay, I'm selling in the market 100,000 shares for $1 each. So when you sell the shares, you get $100,000 in the account. So what this 10:1 ratio means that if you sold the share for $1 preferred shares, you can price your common shares for 10 cents. That is important for option pricing for common employees, because you want to make sure that the employees have as much incentive as possible in the upside. Right? But one thing which there are lots of things with preferred investment and preferred shares. The shares are the same as far as when you incorporate a company. They're all the same class of same shares. The reason they're called preferred versus common is that there's a legal agreement attached to the shares, which makes them preferred. So what is the legal agreement? You should know. The biggest important legal agreement is the concept of participating preferred, what is called. Now, what that means is that suppose investors put in, let's take the example of, okay, let's take a hypothetical example because I shouldn't give you concrete examples. You took $10 million in investment, right? And for $10 million investment, the investors own 70% of the company, roughly. So all the employees are 30%. So suppose you sold the company for 10 million. Employees get 0, because if it is a participating preferred or 1:1, the investors take 10 million out first, and then they get 70% of the rest. Okay, I'm simplifying it. Actually, it's worse than that. So, so if you sold the company for 20 million, then investors take 10 million out first, and the 10 million is distributed in the employees. So when you read about the startups, prices they got, you really have to look on the underlying terms before you know that whether they made any money, the founders. So there was a case, for example, in which the company got sold for 500 million recently. Startup is considered a huge success. They burnt in 225 million, but in this participating preferred, usually an 8% interest is levied. So over 7 years, 8% or 10%, their money got doubled. So 225 became 450 mil. Now, to make matters worse, that when the crash occurred, high-tech crash occurred, many VCs were insisting on participating preferred factor of 2 and 3. So if they invested 10 million and the company was sold for 30 million, they were taking 20 million out first plus interest before it was distributed. So one of the things in this whole business in the VC is that the press release is not a legal document. So we've issued in all startups press release. It's not a legal document unless you are a public company. So you can so as long as you don't so it's quite okay to allow okay. So many investors actually even I've seen actually investing 5 million but announcing they invested 50 million in the companies, and that's called a lens. They call actually the technical term for it, because they know that if they announce a larger amount, the credibility of the startup goes up. So there are all sorts of things which happen in this investment business, which I'll talk more about. There's a valuation issue, and the legal stuff can be quite expensive, but that's where if you've done a startup before, you always learn to make sure you keep all the templates of your previous companies, so you don't have to pay $25,000 to lawyers. You can reuse the same templates, which because it becomes cheap next time. Yeah.
They get 10 times the share.
No. Conversion to common is separately mentioned in the investor clauses. Typically, that happens when the companies are going public. So you have a successful startup and you want to go public, then all the shares are converted into common, including preferred, because it's very hard to trade in preferred shares, because preferred shares, either you fall into public markets standardized stuff, right? So that's what they do. So if you have your preferred contract could be very custom in a high-tech startup. So to get rid of all that stuff, usually they convert into common. So usually they specify 1:1, 1.2:1 or whatever, but they might take out the money anyway before they go common. So you got to watch out.
So another follow-up is, how do you actually come up with these numbers as valuation of the company? How do you sell it to the investor? Like 10 million is 30% of the company. Why would somebody buy that argument?
Ultimately, if you just shop around and you take the best term sheet. Nowadays, most people, if they get 1 or 2, they're lucky. So you really don't have that much bargaining power. Now, but VCs, the only bargaining power you have is that VCs need to invest their money. Okay, and I'll come to that actually, the business model for the investors. And the second is that they know that if the share is too low for employees, they will leave and they will be left with nothing. That's the only two incentives you have. Otherwise, in the bubble time, you would get, a startup would get 10, 20 term sheets, and investors were crazy. They would sign virtually 1 week. Nowadays, they actually go back, sit back, and the strategy is to see you suffer, the startups, and twist in the wind, if you will, because they know they'll get the best valuation then. So, but I'll come to that. It's not as bad as that. So here it depends on where you are in geography. It turns out that the investment for VC's point of view is very different from, you get factor of, if you get evaluation of $1 million in San Jose, you probably get valuation of the company of $500,000 in Boston, probably get 200,000, 200,000 in New York, New Jersey. That much difference where you're located. Financial, I'll just talk quickly about financial. Companies usually underestimate cost, overestimate revenues. But the thing is that a lot of people actually, I thought that financial projections are useless because you're projecting revenues and costs when you have no idea in 3 years, 5 years down the road, right? But it turns out actually the process, the numbers may be wrong, but the process is very useful. So it's a very interesting thing which I've learned. If you do a good job of this, it actually focuses you to identify all the factors for your business which are very different from other people's business. So I would recommend strongly that you go through the process, and the investors, or the savvy ones, they're smart enough to know that how to discount different projections. But they want to know actually that you've gone through the process, you know what is involved in the business. Nothing scares them more than seeing that the money they're going to put in that company, people don't even know what the costs are. So we may run out of time, so I'm going to discuss actually a very important thing. 2 important slides, and then we'll be done. So a lot of people ask me what is the progression of a startup. Usually there is one or more founders, you form team members. Because remember, the whole issue comes down to trust. So team becomes very important. Because investors don't know who these people are, the customers don't know who these people are. So team members become the most important. You raise money. Typically you develop what you think will be a hit product, because you always think the product will sell itself. You bounce off customers. You realize that assuming you can get access to those customers after a few months of calls, is nowhere close to a product. Salespeople start leaving. The reason salespeople start leaving is usually they're given a small base salary plus commission on sales, and that's why all the salespeople are very short-term oriented. Right? So then you go do more work, go back to customers, you raise more money, and then you just wish that somebody like Cisco will buy you out at that point in time. I've seen it happen in dozens of companies, same thing. But of course, remember, all these large companies have been approached by hundreds of companies literally a week to saying buy me, right? So I know Mike Wolpe, who's the M&A guy for Cisco, and I've talked to him several times regarding this thing. It's amazing how many offers they get, propositions they get. They buy this my company, buy this company from different Cisco angles. So it's not that easy to sell to Cisco for that. So you find the major fixes. You know that which partnerships you need to have, technology, business. Then you find, okay, I need to have a sales channel. You raise more money, because every time you raise money, that investors are hassling you. Your percentage of your company is going down, the holdings, right? So you say I want to sell out to Cisco, and then you start selling and raise more money. So usually you have to go through this step several times, right? But once you do it, it's like, this is a game you can go through. I wanted to give you this quick view. So a lot of people say, okay, what happens in a VC funded capitalization? Well, the exact numbers change over the years, and based on the region you are at, geographical region. So typically what happens is, seed stage is when you go to someone like an angel investor who puts in $100,000, $200,000 or $500,000, whatever might be. At that point in time, the founders, which is you and a couple of your friends, you have 50% of the company, the investors have 50% typically. Then you go to Series A, which is typically a VC funded round. Your employees have gone down, so founders have gone down to 30%, and the new employees have gone down to 10%. So it goes. But if you look at it, that at the IPO, so okay, there's no total here, but ultimately in the IPO, when you go IPO, the founders and employees typically will not have more than 20%, and actually the target is more like 12%, because, and actually this is where I discovered, because one of the mysteries to me was that why this table appeared. So I talked to a lot of venture capitalists and says, so why did you come up with this thing? And it turns out that actually the amount of money you seek in the beginning for investors no matter what you seek, the percentages will be roughly remain the same. So whether you're raising $2 million or you're raising $20 million, this is the percentage they'll follow. It's very interesting how venture capitalists work. So not that they'll give you 20 million like this, but you have to justify why you need 20 million, not 2 million. So it turns out that when I was running the public company, my CFO came to me and says that, hey, wait a minute, we have a problem. I said, what is the problem? The employee option pool has exceeded 12%. So I said, what's the big deal about that? And he said, well, it's actually a red flag in the market. So like Google was an exception, of course. But so what happens is they go backwards from that, roughly 12 to 15% from that IPO, and then calculate the percentages. This is how roughly the percentages come. Don't get too disappointed, because by the time the IPO happens, it should be at least $500 million company. That's what the expectation is. But no, these are founders and employees all have common. Yeah, in this one the assumption is founders and employees are common. You can have founders, a lot of founders who invest their own money, so they'll be in both tables then. But then that's a bad idea. Usually what happens if you invest your own money, the VCs come in and they discount that. They don't want founders to have preferred shares, because then a founder can leave and they still have shares in the company. So they don't like that at all. The sweat equity, they'll zero it out anyway. So, VC, I'm talking about venture capitalist model. Yeah.
So at what point in this do you start, the VCs start wresting control out kind of?
They wrested control where?
In terms of decision making and control, because of the preferred and the non-preferred, as we talked about.
Typically, they might do it even seed or Series A.
And this is an unavoidable kind of thing in terms of.
If you go to the venture capitalist round, yeah. But there are other routes which I want to talk about. This is very important. Which is actually the new things happening last couple of years. Yeah, because remember, even if they have less shares, they'll have control, saying that they have board seats and control. Because from their perspective, once they're given the money, if they don't have control, you can burn the money, either because you don't care or you don't know, you're not experienced enough. That's one of the reasons why in actually other countries of the world, including India and places like that, because the corruption level is higher, there have been cases of VCs actually investing in high-tech product companies, finding out that next week they came and the entire company disappeared. There was nobody there. So there was a friend of mine who actually went and set up in Bombay a venture fund. Mark, he was not Indian, but he formed it. And he said he was shocked. He came back and the entire company was gone, 50 people. And he said they were so stupid, because it was only hardly $250,000. They would have made 20 million in a year, but they got greedy with few $100,000. That was 5 years ago. So, but now of course the president. So it has happened in the US also, and that's one of the reasons why VCs like to have control. And for early stage startups, they want local, because they can visit the company every week, spend few hours, and which has become a huge problem for New York, New Jersey, because all the VCs are in San Jose and Boston. So if you're an early stage high-tech startup, those people don't want to invest in New York, New Jersey.
So the way early stage is determined is that you haven't defined a product yet?
No. Early stage means you don't have revenues yet. Okay, a lot of people define it different way.
So you've already identified a product and then you have
Yeah.
a sales function.
No.
All those stages.
No. I say that's very good question, because everyone defines it differently. The real early stage is, of course, when you have a idea and a PowerPoint presentation, right? So for that only San Jose there'll be few VCs will fund it, nowhere else in the world. PowerPoint and idea. Then you have a technology you developed, your patents, stuff like that. Then in that case, you might go to Boston and get it funded. Early stage in New Jersey means you already have the product developed virtually, but you don't have sales revenues. Most New York, New Jersey VCs are investing in firms with revenues of, like Edison Venture Fund. I talked to them last week. Their model is $20 million in revenue. So why they call them venture fund? So it's like, so there are all these issues. So this is how you get started, but let me just skip this, because all it says that you write business plan and find investment. So let me just quickly talk about this types of investors. Because historically in the bubble time, a lot of people have heard about venture capitalists, which is, and venture capitalists historically have been the biggest investors in the US economy, high-tech economy, and that's why everyone knows about it. One of the things you have to do in investors actually is that you have to almost consider this as your marketing customer. They are your customers for your business plan, right? So you have, so when you want to sell to a customer, what do you have to do? You have to find out how they work. What do they actually buy? What is their decision-making process? How do they make money? You have to understand all of these things about the investors as a group and as individually. So this is otherwise you'll waste huge amount of time, and you'll have given up your ideas, because investors. One of the bad things about investors is, even if they have no intention of investing in you, they will take all the information from you. And they will keep on taking information from you, because from their perspective, they are gaining from that exercise information. Right? And if they take information from you, it helps them in evaluating the next proposal which they might want to invest in. So one of the hardest things about investors, which is I used to be so offended in the beginning, now I'm not, I just given up on it, is the fact that these people take the information and they will share it with you. Most of them don't sign non-disclosure agreements, and they will share it with you. I've had investors, VCs, who told me they didn't have any competitive investment they had, and they would give to a competing company the business plan. Right? So there's the art of writing the business plan. You have to be careful, how to do that and stuff. But the thing is that you have to understand the models of the business plan. So let's quickly go through all this stuff, because we don't have that much time. Angel investors. Angel investors, for the first time last year, invested more money in early stage companies than VCs did. So venture capitalists have been reducing investment in early stage companies. In a typical early stage high-tech startup, the returns you expect is 1:30 times. So if you invested $1, you should get $30 back. What these people are doing now is saying that I don't want $30 back. I want, instead of $1, I want $1.50 or $2 back. So the model has changed to 50%, 100%. For that, they found out the risk is very low, downside, and the sweet spot is companies' revenues of $15 to $20 million revenue. So a lot of venture fund has moved upscale in that sense. So as a result, a lot of angel investors have stepped in. Angel investors means individual, and there are angel groups which has formed all over the country. In fact, in New Jersey, there are 2 angel groups, and they are both extreme. In fact, the New Jersey angel group has, because of the lack of the venture fund market, has proved to be the most active, top 3 active angel group firm in the US, in New Jersey. So if you want connections, I can just bring you to them. So angel groups in New Jersey, and they've been investing more on it. Venture capitalists. So how does a venture capitalist work? What they do is that venture capitalists form a fund, saying this is a fund for energy funds. Okay. First thing you have to understand, venture capitalists, they are a herd mentality, right? So they go by waves. So there was a wave for telco networking. As of this year is energy. So you happen to hit the sweet spot, everyone wants to go after you. Right? But venture capitalists, they have a fund, and typically they charge 2.5% of that fund as management fees, and they keep 20 to 30% of the profits. Right? Now, the other thing which has happened is that venture fund, because they've been asked to lower the risk level after the crash, because they started investing in more mature companies which need more money. So each investment is higher. So VC firms have grown up in size from a couple of $100 million to few $1 billion. But the number of partners they have is still the same, few. So each partner now wants to invest. So again, for example, in Boston, the sweet spot for investment for a VC firm now is 12 million. It's not 10, it's not 14, it's 12. Why is that? It will change in 3 months. In San Jose is around 18 million. Based on the amount, because one partner can only manage 3 or 4 companies. You can't manage so many companies, and you have 4 partners, and you have $1 billion to invest. So that's how. So it's really weird how the whole thing works. Actually, strange.
So if they are investing individually, so why?
No, they're not investing individually. They have to manage, right? So somebody has to sit on the board and manage the company. So it takes a huge amount of time because they're really hand-holding the company, introductions and stuff. So you really have to find, also venture capital, again their models are, okay, what areas they invest in, how much is the money they invest in, what is their threshold capability, what is the maturity of the fund. So many of the venture cap funds have maturity cycle. When the fund is newly created, they invest in early stage startups. Then the rest of the money they reserve for the startups they've already funded in, because they will need more money down the road. So if you come after a fund which is already midway or mature, you're wasting your time. They will take all your information, don't get me wrong. They will talk to you. They'll get all the information from you, but they will not invest. So you have to have a network of people who give you the information you can call and says, okay, this is what this investor does. So there's a whole actually considerable effort involved in getting investment in these time, in normal times. Bubble time was the only exception, but historically it's always been like that. Whether it was from the times of Edison. Actually, if you read books of Edison, how he used to get money is very interesting. He actually even faked a demo once to get money. Now the private equity. Private equity are typically they're financial driven investments. So one of the things with the VCs and angel investors is that they can look at the technology concept and translate into a business for you. The private equity guys just look at the balance sheets. So they'll say, okay, are you making, how much profit you have, how much revenues you have, how much growth you have. So private equity guys are financial guys. They look at the opportunity, say, okay, if I cut down cost and if I merge this company with that company, but they are moving into, so for example, for one of the startups, right? So let me give you an interesting example. Because of the public company I worked in, gave me contact exposure to Wall Street. So what we are actually trying to do for one startup is buy a much larger company. So high-tech startup buying a much larger company and working with a private equity firm. Because private equity firm would rather have the management from the startup running the bigger company. So that's an innovative way of financing the startup. It might fall apart, it's not happened yet. It might happen, but well, there's an interesting twist on you can actually do with private equity guys. They are the most flexible, and the amount of money is huge, hundreds of billions of dollars sitting. So they are also getting very creative because they need to use that money somehow. Right? Otherwise, their investors in that fund, private equity funds, they'll get disappointed with returns. If you're getting interest in a bank, so they're getting very creative. While VCs have become more like private equity guys, private equity they are getting more adventurous. So public markets. So there are basically three classes of public. Now another interesting thing which is happening recently is that came across 4 or 5 companies in New Jersey which have been raising money from startups, which have raised successfully money from public markets, and one of them raised 75 million over a period of 4 years, 0 revenues. Right. This actually trend started from high-tech biotech firms in late 80s. They could go public, but in the biotech the product cycle was assumed to be 10 to 15 years, so it was okay. Customers, people were waiting to hear from that. So in the public market you want to go is that there's something called pink sheets. Pink sheet is actually there's a company called Pink Sheet LLC, right? They actually they facilitated trading and buying of shares, which originally was done on paper, which was pink in color. That's how they got the name. They're not a stock exchange. So if you're in pink sheets, if there's a viable market, there are no reporting requirements for SEC or any of the stock exchange regulatory environments. So this company which I knew is a pink sheet company. So they actually, if you look at stock, there are .p suffix to it. If you look on the market, so pink sheets you need to understand that how that works. There are brokers all over the place. Actually, a lot of the brokers I didn't know in pink sheets were actually in Brooklyn, not in Wall Street. There's a whole area where all these brokers exist. They'll call you and they'll send you, this is spam emails. You see, there are a lot of these pink sheets and OTCs. OTCs are over the counter. Over the counter, there's a bulletin board and you can trade. Actually, but here they are reporting requirements. So OTC is slightly more expensive to run like this. So reporting requirements mean what? So SEC has a whole set of regulations to protect small investors, and that's all the public markets are about. So what they want to make sure that the large sophisticated investors don't have specialize in this insider knowledge on, and they can't gain, which historically happened in the US a lot before these laws were put in place. So they instituted all these laws, which are called the SEC laws, to protect the common shareholders. That's why the law is like all the information must be disseminated at the same time to all the shareholders. So all these are actually protection of the common ones. So now when you do that, so all you have to write up a lot of this stuff, and the stuff is written by CFOs, which are expensive, by legal teams, because anyone can sue you on that basis, and they are also you have to get audited, and audited, every audit costs you $35,000 or something. Like Pricewaterhouse used to be all these companies. I don't even know which one exists. So NASDAQ and New York Stock Exchange are the most expensive. And they are stock exchanges, and you have to do all the reporting requirements. OTC is much less, and pink sheet is virtually nothing in terms of this thing. Now there's another interesting things we have come up called SPACs. These are called special purpose acquisition companies. So here what happens is, this is now again because hedge funds have a lot of money, is being created by hedge funds. They give you you form you say that okay, you form a public company shell, and you say I want to raise $25 million. So these hedge funds will put $25 million in your public company, with the rule that you can invest in anything you like. You have to describe it in the regulations, but it has to be approved by the shareholders. You can acquire any technology, any company with revenues or no revenues either. But if you don't use that money in 2 years, you have to return 98% of the money back to investors. Right? Now, you scratch your head and say, how does the whole thing work, right? Why do this? Why don't you go to private equity and stuff like that? It turns out, which I also couldn't figure out because they're very new. They're almost like 1 year. So I talked to this guy who actually raised 30 million. Very, very smooth, polished Wall Street guy. He could have raised that kind of thing. So then he explained to me the way it works is hedge funds. Hedge funds are actually using these public companies to hedge against their bets. And that's the reason they've been created and flying. There's some complicated way. So the fact is, but from high-tech startup point of view, the way I look at it is that who cares why it's working. The fact is that all these markets now, because the venture capitalists have been doing a dismal job, at least for our area. Like energy, they are investing tons of money, but for electrical engineering, computer science. In computer science, I think the closest they come to is Web 2.0 commerce or marketing companies virtually. They're investing a lot in that. But there are all these new vehicles coming up, private equity, angel investors, of course, the pink sheets, OTCs, SPACs for the stock, this thing. And of course, the government grants exist. But the problem with the government grants historically always is that it's a good, it lets you start and gives you the illusion that your business, you solve your business problems, but it really doesn't. Right? Because all the business issues are still there to be solved, whether it's marketing, sales, and stuff. I think you can spend 7-8 months. And I think that's about it all. I already talked verbally about this, so if you have any questions, I can take them now.